Is this a scenario where investors need to be scared about what's happening with the Chinese market action? You wouldn't blame them seeing their major benchmarks down 7 to 8% overnight.
I think a lot of people are also expecting that possibly we were going to see it open to the maximum 10% threshold, and that we didn't. And that's because the PBOC showed that they're going to be there. They're having a massive amount of stimulus that's going to be pumped into the economy. They're basically using their bazooka that they were holding in their reserves in case the trade war fell apart. There's plenty of stimulus that's going to be hitting the markets, and I think that's why we're seeing there's still some optimism that we're not going to have everything completely collapse as far as global equities, and we're probably going to see more efforts globally to provide more accommodation.
So if those efforts are going to happen globally, and if we've seen some of the selling pressure alleviated perhaps because other markets in Asia have been used as proxies for those Chinese markets as they've been closed, what then do investors do? Do you still pile into treasuries? Do you still pile into gold? Do you buy yen? What is it that investors do now, given the uncertainty?
Well, I think right now, when you're taking a look at what's happened, we were at a very toppish market before this virus came into place. Earnings were great. Consumer sentiment was soaring. Credit markets were healthy. Valuations were stretched. And there was going to be a catalyst. And right now, the markets are using this virus as a catalyst to basically see a little bit of profit taking come into place. And now you're having a lot of the hedge funds, the high frequency systems, they're just kind of driving this market down. But the institutional trader, I was speaking to traders over the weekend, and they're saying, we're going to buy the dip and let this rip. There's still optimism that this is just a short-term setback. And that's why you're going to see equities try to be resilient, but there's still so much uncertainty that we still could see, I think.
So you're talking to institutional clients on your end who are saying that they are going to buy the dip, and this is as deep as it gets. I mean, we're only about 2 to 3% from record highs in the U.S. Is that really all it takes right now? Is every 2 to 4% dip in the market buyable? And is that uptrend intact?
And I think it's right now based off of central bank policy. The Fed is on hold. There's expectations that if things get ugly, we're going to see the Fed also jump into the picture, possibly delivering more rate cuts. And with this overall uncertainty as far as how long, when are we going to see the virus peak? And if we see it peak, is similar to SARS, this could drag out a few more months. And there's expectations that you're going to probably have more money come back into the playing field, because this is just going to be maybe a short-term hiccup on industrial production globally, and we're going to possibly see that there's going to be still further momentum for that global rebound story that we were expecting to have before this virus came into place.